70% cancellation rate.
Right.
They built you up. You didn't build them. Texas is now running out of cheap land. Things that I said were true because I said them. The slowness is happening across the board. Elon has just made a very big mistake.
G'day, Neal. Welcome to the show. How you doing today, mate?
G'day. It's fantastic to be on the podcast finally. We've talked about it, and now we finally get to do it.
Yeah, I know. It's been a minute. I feel like I've seen you enough on my social media links that I thought you were already on the show. And like, we rub shoulders in so many different circles.
I'm everywhere.
Yeah, you're everywhere. Exactly. But we'll get into what you've been up to in a bit. But I want to unpack the old Neal, the young Neal, and rewind the clock and tell me how you made your first ever dollar as a kid.
Yeah, it was actually the first ever rupee. So I was 12 years old, and inkjet printers had come out. Back then, there was this company called Epson. I think they're still around. They used to make inkjet printers. So I went to my mom and I said, hey, I need to buy an inkjet printer. And she's like, it costs 16,000 rupees. I mean, that's like a month's salary. I'm not paying it for you. So I said, what if I was able to do some desktop publishing type, documents for people? And she said, yeah, but, how are you going to do that? So I said, the neighbor's got one. Maybe I can do it for him for a week and prove it to you that I can do it. So I went to all of the shops. So there would used to be like individual shops in India. There still are. And I would go there and I would beg them to let me put a brochure on. So I printed like a 8.5 by 11 brochure talking about my desktop publishing skills and things like that. And I put those things up there. And sure enough, the phone started ringing and people started coming in with interest. So for a week, I begged my neighbor to use his printer. And then after a week, I had a brand new Epson printer, and it took me about 18 months to pay back my mom back for that printer. And as I went through the process, people started coming in not for desktop publishing, but for brochure design. So I got into brochure design using a software called PageMaker, Aldus PageMaker. And then from there on, I went on to being an exclusive designer of movie posters. So there's so many B and C grade Indian movies that, they used to have less money. So they would basically show up at my house and I'd sit there and, crop out famous movie artists and put their, stuff into posters. So you can imagine what's on the wall of my bedroom in India are all the posters that I made for movie artists. And that really got me into entrepreneurship and into, learning how to make my own money. I never made a huge amount of money doing it, but it was just an incredible amount of fun.
Yeah, no, I could imagine. And it's something that sounds like you're very passionate about. And as a kid, being curious about different softwares and back in the day when software was such a new entity in this world, right? And so many people didn't know a lot about it and were probably scared about it, to have a young kid just showing them the ropes and creating these posters. That's freaking awesome.
They'd be shocked, right? I mean, I was 16 years old and they would come up and they would be like, no, I want to talk to this Neal Bawa guy. And I'm like, I'm Neal Bawa. And like, you're the guy that designed that poster for that company? I'm like, yeah. And they're like, no. And it's like, come sit down next to me. Because I basically had a desk with two chairs. So they'd have to sit next to me. And then we'd basically sit and design it on the screen in front. I had a 12-inch monitor that we were designing using CorelDRAW.
That's awesome. But walk us through the journey to entrepreneurship and the story of moving to the United States before you got into the world of multifamily real estate.
Yeah, well, the challenge was that even though my mom liked what I was doing with the printer thing, but in the end, she was like every other Indian parent, you need to be an engineer or a doctor, so you got to pick one of those branches. So I went to computer school, got my degree, and then showed up in the US, on an H-1B visa. Luckily, timing was awesome because it was 1997. So, right, there'd be 50 companies lining up to hire you in 1997 as a software engineer. So I went in, I built enterprise networks for Cisco in the San Francisco Bay Area, had 30 people working for me at one point. I was still working for a company, but these people, I was recruiting them. So I had a great tech career, and eventually the company ended up making me a partner. And we started growing, and we were doing all this growth. And one day my CEO said, I hate being, our landlord hates us and we hate our landlord. Let's figure out how to build our own building. So I'm one of those weird people in real estate whose first experience in real estate was not a single family rental. I didn't even own my own home. I was renting with somebody else, but I was building a $6 million campus from scratch.
Wow.
And we basically figured out how to do it as we bought a piece of land, and then we figured out what we had to do. We didn't even know words like zoning and permitting and entitlement. We would just show up at the city and say, how do we take this piece of land and turn it into a campus, right? So by the time we ended up, it was so wildly profitable, Reed, that it was the catalyst for our growth. So I learned about real estate in a completely different fashion as a accelerator to my technology business. And then 1 year later, I realized something massive, that I didn't pay any taxes because I was a partner in that building. And once the depreciation started coming in from a gigantic building like that, I wasn't paying any taxes. And that got me fantastically hooked onto real estate. And then in 2008, and by this time, 2008, the crash had happened. So the timing was great. I did a lot of data analysis, and I can tell you the story of that in detail. But basically, I went out and did the exact opposite of what people were telling me. My family refused to talk with me for 18 months for doing so. But as a result, I ended up starting to make 10 times my salary in real estate. And I was still doing full-time tech, full-time salary, but I was noticing I'm making way more money on the other side. And so over 6 years, I sold my company, the technology company, in 2013, and fully transitioned in late 2013, early 2014.
And obviously been good timing where it's been the biggest run and bull market in multifamily. Yes. And
incredible run.
Incredible run. So what has been over the last, call it, more than that, 8 years.
8 years.
8 years. What have you bought, and where have you come full cycle? Because I know in the green room before pressing play here, I want to get into what you're building today.
Okay. So early on, very, very, very standard, right? So I'm going to go back a little bit from the 8 years. I'll go back to 2009 because that's really where I started. In 2009, I'm a data scientist by profession. So my data science was telling me that buying real estate was impossible to lose money. But every party that I would go to, people would basically just be bashing real estate. And I'm trying to tell them, look, you're buying something that at this point is costing basically 40% of what it cost to build it. And on day one, you can be profitable. On day one, you can be making thousands of dollars. Nobody was willing to listen to me. As I said, my family basically would refuse to talk with me because they were so afraid that I was going to burn all of my money in real estate. So I said, if I'm going to go and make this stupid mistake, I might as well use data. So later on, if I screw up, at least I can show people I used some data, and maybe that'll get me some leniency. So I went to a Ukrainian hacker and I mined the Zillow website and the Bureau of Labor Statistic website, and basically mashed it together to see which city in the United States had fallen the most from the 2005 peak. And I was very lucky in that the city happened to be 144 miles from my house in the San Francisco Bay Area. It was near Fresno. It was called Madera, California. So I show up there, I go to a broker and I say, are there building availables? He says, Neal, half the city is for sale. And I say, okay, so shouldn't I buy half the city? He's like, yeah, but where are you going to find tenants? And he was right. I mean, the half the city was empty. There are all these brand new construction homes that had been sold to agricultural workers who had since disappeared, Mexicans, they had disappeared. And so now half the city was empty. But these were beautiful homes. They were selling them for $100,000 each, probably cost $200,000 to build, 4-bedroom houses, beautiful, 2 floors. And I'm like, I want as many of these as possible, but I have to find a way to rent them. Otherwise, I'm going to bleed. Another 20 miles to Fresno. I go find a broker and I tell him I want to buy one old property, old property. Got to be at least 25 years old in Fresno. So he sells me a property the next week, and I take that property and start advertising it on 30 different rental engines using my Ukrainian hacker. So he writes me a script, and it's now like this property is the most famous property on the web. Now I have hundreds of leads coming in. And I hire a Filipino worker. I now have 20 employees in the Philippines, but she was my first. I hire this person to basically pick up the phone and talk to all these leads and give them money to convince them to come to Madera, which is 20 miles away. And we managed to convince enough people to start getting a flow of people from Fresno into Madera. And by the time it started to work out, I was confident. I was like, I can rent these homes. So I started to one after the other buy them. Eventually ended up buying 13 single family homes. And that basically got things started for me and gave me enough money to start to research real estate. But the biggest thing it was the data science. So then I went on and created a toolkit called the Location Magic Toolkit. This took about a year to do using a statistical software called R. And that location magic thing sort of just exploded because there were so many nerds and geeks and dorks in the San Francisco Bay Area. I mean, this is Silicon Valley, right? I would go and do a webinar about using data science to find the best cities in the US to invest in and tell people my story. And the first time there were 4 people read, like a year later, there were 200 in the room, right? Like there were all these geeks and nerds and dorks. Now you can imagine hundreds of them are my investors. And for 4 years, I was basically building this toolkit while people are telling me, how do I invest with you? And I'm like, no. You're standing inside my technology company. You're in a conference room of my tech company. I run a tech company. I'm just sharing this because I think it's really cool. And people are like, you got to find a way to monetize this, Neal. And then in around 2012, enough people had told me that I was like, I think it's time for me to sell my technology company. So we sold it in 13. In 14, I get into real estate. Like most people, I start with small multifamily. I think the first one was 7 units, and then I jumped and 200 units, and basically bought about $300-400 million worth of multifamily. And then I started getting feeling that multifamily was getting too expensive. I was wrong at that point because this is just 2017, and obviously subsequently got a lot more expensive. And so what I did was I decided to split my business into 2 pieces. And the first business would keep buying multifamilies, which I do to this day. And then the second piece would, in addition to buying multifamilies, would start to build. And so I wanted to learn how to build. So I first partnered with other folks that were building. So I sort of became their equity pipeline to learn and to figure out what this whole process was like. I had built before. Remember, I'd built a campus in 2003, but this was different. It was multifamily, and I needed to, learn the ropes. So I did a few projects with them. And then eventually I opened my own development division, hired my in-house staff that does the development process. And so those things went really well. So at the same time, we were doing value adds, and that was helping me with depreciation and giving cash flow to my investors. But I think by 2019, 50% of our business was going into large development projects, much more profitable, much higher fees. And that was working well. And then in 2020, I met a company. It was January 2020. I met this company that sold me on the concept of wellness real estate. They said, wellness in real estate, the concept of purified air, purified water, circadian rhythms, this is going to be the next 30 years. This is going to be, just like low flow toilets. Reed knows exactly what I'm talking about when I talk about low flow toilets. In the 80s, low flow toilets were a big thing, and now we don't ever build a building without those things. And so this is like wellness is the next thing. And I thought about it, and they wanted to do a multi-billion-dollar company at the beginning of 2020. And I'm like, I'm not that courageous. So I said, how about we do something tiny, like really small? And so we built a 32-unit wellness project in Houston starting 2020. And once I started that process, I realized they were absolutely right. So then over the next 2 years through COVID, which was crazy because, we started the plan about 4 months before COVID, and all of a sudden we look like rock stars after COVID because everyone cares about wellness real estate. And the company whose equipment we were using, their sales tripled overnight. Their sales just went through the roof. And now everyone's like, we care about air, we care about water, we care about health. And so we were like, okay, we got to ride this tsunami. So we ended up doing 5 projects in 2020 and 2021. And then in 2021, I was like, it's time to develop this into a company. So I'll stop here, but basically, that was sort of the journey, the multifamily journey. And on the way, I played with storage and industrial and student housing, but I never left my core of multifamily because that's what I felt the most comfortable with.
Well, it also sounds like you've done a lot of pivoting along the way, and I know you personally, and it's, the mad scientist, you have that, that shiny object syndrome, but you're one of those guys that actually goes out and picks up the shiny object, right? And hopefully has a team to support you in your big idea thinking. And I'm actually reading Richard Branson's book, and you have a lot of similarities with him, like the way he thinks about let's go and create something in a different niche outside of what we're already doing, but it can be a symbiotic relationship with the current business of multifamily. So really, really love that. Let's talk about wellness real estate. I'm interested. My wife is an eco interior designer. She uses all, the word LEED is popped around a lot, but LEED is also just another way to slap on 20% more on any products. But building from a more holistic way and off-gassing and different paints and renewable resources in terms of flooring and where you're getting your waste from a construction site. Talk to me about how the wellness, the ecosystem of a wellness real estate.
Absolutely. My story is tied back to a company called Delos, so I'll explain why. So I'll start with the word that you used, LEED, right? So LEED is a standard. Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. For new construction of any kind of building, because it could be an office building, could be a multifamily, in such a way that it's environmentally better. So it uses less energy. It's holistically healthier. But for the most part, LEED is tied to energy consumption. You want to reduce energy. The problem with LEED is you're only talking about 5% of the buildings on the planet, the brand new ones. Well, what do you do with the remaining 95% of the buildings on the planet? So back in 2012, there was a guy named Paul Shala who with his brother Peter Shala was a top level guy at Goldman Sachs. I mean, these are people talking to Lloyd Blankfein every day. That's how high they were in the organization. And they felt that what LEED was doing was very short-sighted. They were only going after new construction. 95% of the buildings are already built. So they started a company called Delos, and Delos basically focused on the other 95%. And to do that, they spent $100 million of their money and Goldman Sachs money to create the well living standard. So they built an institute, the IWBI, the Institute of Wellness. It's an International Well Building Institute is the name of the institute. And that institute created the well building standard. It's a logo. Like if you go to like 6,000 Chase branches in the US, JP Chase Morgan branches, you see a logo outside called Well Living. What that means is this existing building is well certified for air filtration, water filtration, circadian rhythms. It basically is a healthy place, right? Some of the least healthy places in America are indoors. The buildings we live in and work in are ridiculously unhealthy compared to walking outside. And most people don't know this. It's simply a lack of knowledge. So the goal of the Well Living Institute was to disseminate this and create a standard, not just for new construction, but also for existing buildings. And it sort of exploded, so much so that today, LEED, which has 20 billion square feet under contract, is in partnership with Well, right? So the two companies became partners together, and they present at all of the big conferences together, and they have joint certification programs with LEED primarily being for new construction and Well being for both new construction and existing buildings. And as those standards were defined, this thing called ESG exploded. So ESG basically is a standard designed by one company called BlackRock. And it's a standard that they enforce on any kind of business, on any kind of real estate, saying you're either good for the environment or you suck at it. So obviously oil companies bad, Tesla good, that sort of thing. But it's now applied to everything. And why does it matter? Because ESG is now the basis on which all the large trillion-dollar funds are making investment decisions. So it became massively large in 3 years. So this company, Delos, as you can imagine, once pandemic happened and once ESG happened all at the same time, Delos became an absolute unicorn. And we realized we could be on their coattails. So we created a company called YouGrow, which is basically a wellness living real estate company that uses two incredible trends. Number one, 100% of our units are well living units, filtered air, filtered water, circadian rhythms. You can use your smartphone to see how clean your air is and your water is. And then the second trend was build to rent, BTR, which we believe is a new multifamily, right? It's new construction multifamily, but it's not like dense multifamily. It's not one building with 25 families living in it, but it's a townhome or a very small single family. So we took built to rent, combined wellness living, and opened a company called YouGrow. Went to our investors, told them we need a very large amount of money. They gave us $120 million. And then we partnered with Delos itself, and our investors have now invested $10 million into Delos, the company, as well. And I'm on the advisory board of Delos, together with Deepak Chopra, with Leonardo DiCaprio, and Lloyd Blankfein, the past CEO of Goldman Sachs. So my goal now is I'm continuing to do what you do, Reed. I'm continuing to buy value-add buildings because, boy, do I need tax savings personally, right? So, and there's nothing better than buying buildings as a general partner. So I continue buying those. And of my 800 investors that are currently invested in projects, there's maybe 300 that are invested in value-add. But the rest of my investors are following me into this new world of build-to-rent, new construction with 100% wellness living. And that's the story. This is why I disappeared. At the beginning, when I walked in, you said, why haven't I seen you for 18 months? And the answer is, I had this big, hairy, audacious goal and was taking 80 hours a week. And I didn't have the time to show up at the same conferences that you speak at.
Yep. No, look, and I love what you built here. And this, thank you for bringing, educating us on IWB and ESG, because it's important to understand how that all ties into LEED. I'm a former structural engineer. I've built a lot of projects across the US, UK, Australia, and it is, you're right. It is such a big area of the market that they're not serving, right? And my wife's an interior designer as well. And, I've always joked that LEED is an excuse for GCs to slap on a little bit extra, cost. They talk about LEED equivalent, but to the existing buildings, and I own old buildings. Like, how do you come in and replace the HVAC? How do you come in and replace the inefficiencies in windows, or the piping, the cast iron piping, all that? Interferes with how we as humans live. So are you doing that in a space like for value, like, the people who own $50,000 to $60,000 a year, or are you only doing it in the top end, people who own $100,000 a year? Because they're two different markets and the two different rent premiums. And I could only imagine that at the end of the day, you're a business and it needs to pencil out.
Absolutely. So most of Delos's business, I'll start with them and then I'll come, answer your question. Most of Delos's business is, office buildings, stadiums, centralized, where the HVAC systems are centralized, so it's easier to tweak them and improve them. They haven't done much with multifamily. And the big reason for that is that apart from the 200 unit buildings that you and I own, it's very hard. It's a very scattered market because there's tens of millions of homes with homeowners that may or may not be able to pay for these kinds of upgrades. So Delos, for the first 6 years, didn't look at the single family market at all. Then they became aware that the multifamily market is starting to transition from just multifamily buildings to build to rent. Keep in mind that 5 years ago, so there's about 330,000 new multifamily units built in the US every year. That's the average. So 1 million every 3 years. Out of that 330, 1% was built to rent 5 years ago. And this, I think, number is going to shock you. This year, the number's over 20%. Over 20% of multifamily construction in the US is now built to rent. It's gone from nothing to 20% so fast that most people haven't even realized just how much market it's taken. $75 billion was raised after the pandemic by various entities just to build to rent. And so they always became aware that build to rent was this new supernova, and people that were building, like me, thousands of units of build to rent, we could make that decision instead of individual homeowners. So we could basically, as we were building Class A properties, most build to rent, by the way, is Class A. You can't really build much build to rent that's Class B. I've built some, but my focus is on building Class A built to rent. So to me, adding $1,800 per unit to give me the air and filtered water, when I do the math on that, that's only $30 a month in rent. I can sell that to Class A. I cannot sell it to Class C at all.
Right.
So to me, the business case made sense. So what my company does is every time we build a built to rent unit, Delos is already in there, and my buildings are powered by Delos. They are Delos powered wellness living. The logo, the brand is so amazing. In Texas, when people are walking in, they can actually smell the difference and feel the difference. And then we get phone calls, our leasing agents get phone calls saying, hey, this other person heard that, that you can live in a building with purified air and water, and they want to come in and live here. They want to check it out. So $30 more, we're getting leasing efficiencies that are massive because the building it filters out COVID. But just so you know, the Delos system completely filters out COVID. And it wasn't, obviously the system was designed well before COVID, but it luckily was the particle size for COVID was such that it doesn't go through a Delos filter, it gets stuck. So the buildings internally don't have any COVID. The air is being circulated, and it's sucking all of the COVID out. So, I mean, this stuff has just exploded. ESG now, for those of you that don't know, just Google the word, what is ESG? And you'll notice that it is a $1 trillion initiative. And it's led by BlackRock, the largest holder of assets on the planet. BlackRock invented ESG. Right. And by the way, most Republicans hate it because it's enforcement of social and environmental standards on companies. But what can they do about it? BlackRock is basically the biggest entity on the planet. They're holding $7 trillion worth of assets.
It's absolutely fascinating. It still begs the question of the stuff, how do you get it into? I own a building that's built in 1965. It's a pain in the ass to try and upgrade everything, and there seems to be a gap missing. It's great for Class A, it's great for people who can afford it, but where the need has always been, which is what you're still in and I own, is that more of workforce affordable housing. So how do you think it's going to transition, if at all, into that space to provide it to the wider public? Do you think it's got a future in that?
It absolutely has, and I'm going to give you information now I've only been allowed to tell people about this since yesterday. So I have a role on the Delos board. I mean, and obviously there's superstars on this board, like Leo DiCaprio, right? Jennifer Lopez does ads for Delos all the time. You can Google them. So my goal is, how do we take the Delos product and move it backwards, not just at new construction products where we're having success, and look at Class A, how do we retrofit? And then Class B, how do we retrofit? And then Class C, I don't think that we'll ever get to Class C, but I think Class B buildings, and there's so many of them, I think that $30 premium works. And I'll tell you why it works. Once the well standard and the Delos seal become visible on most buildings. Right now, Chase Bank, you go in there, it's there. Yankee Stadium is well certified. More and more that seal becomes visible, it becomes easier and easier for Class A people to pay a premium. Once Class A people are paying a premium, it becomes easier for the Bs to pay a premium. So it's a trickle-down effect, and I think it takes an entire decade, a decade and a half to get this done. But I think it's a one-time transition that really has to happen, because I don't think the costs are that atrocious. People are not going to pay $100 a month for this. But in some areas, by the way, it's happening and it's explosively profitable. Let me give you a number that you as an entrepreneur are going to be blown away by this, right? You and I sit around a table and we talk about, we're going to rehab this unit and rehab that unit. We do that. It's part of our life, right? So we sit down and somebody says, okay, well, we're going to spend $9,000 and we have on this unit and we have this 3-year return. That's very common, right? We talk about that. What if you had a product that had an 8-week ROI? 8 weeks, right? It's not my product. I'm just telling you a story that's just so mind-blowing, right? Delos has a product called Stay Well, where they upgrade 100 hotel rooms in a day. And the very next day, because that room is now a Stay Well branded room, it gets a $30 a day premium. And because of that, all of MGM, all of Marriott, all of their luxury hotels are now being upgraded to Stay Well, because they're getting an 8-week ROI on their investment. That is how much people care about this stuff since COVID, right?
No.
And, right. I mean, and obviously I don't know how to own hotels, so this is not great news for me, but I'm learning from this and saying, how do I bring this to multifamily? And I think BTR, built to rent, new construction is a great place to start, but I'm really looking forward to taking it to Class A. I'm looking forward to talking with Reed about this and doing this is part of my job as an advisory board member for Delos, is to basically sit down with Reed and say, let's send 10 units, 20 units to you for this building that you have in this nice Class B area. Go ahead and upgrade it. Let's charge a premium. Let's see what that number looks like. Let's do more.
I also think there needs to be, stuff like the nuts and the meat and potatoes of buildings, right? And as things cost more to build from scratch, I have a thesis that older buildings, even in transitioning neighborhoods, are still worth investing in, because you're going to still have people lining up the door who can only afford to pay $1,000 to $1,500. But I have buildings as well, they're only single pane windows, and I'm like, I'd love to have a government subsidy to come and so I can rip out all the windows and freaking do all the windows again, and I go get an insurance claim on the roof. Okay, roof's done. Orangeburg piping in the ground. I've got to rip that out. Put the new PVC in. There's all these things that that will then, if I do that, that building is now going to last for another 50 more years, right? It's still going to provide housing in that quote unquote workforce affordable space. That how do you have a combination of government intervention, because some of this stuff costs a lot of money, with what you're saying, and still providing an affordable product? That is the hard trifecta to nail, because there are so many existing buildings out there, to your point, that do need that love in order to give them another 50 years of life down the line. I've seen some in markets like Phoenix, for example. I've seen some investors come in, completely do all the windows, completely do all the roof, do all the horizontal plumbing, do the vertical stacks, do all no HVAC. The building was built in 1960. Well, they've just renovated it. It's now a 2020 build product, because it's now going to last till 2060, right? Because it's been breathed more life into it, and I'm interested in that, because I'm in the coal phase doing it with some of my properties. But how do you bring what with you grow into it, to try and make it, and some sort of government help, because developers just can't do it all on their own, because you can't just always build new product and charge the $2,000 rents. It's trying to make it more affordable in the same sense. Something that I'm very interested in, want to definitely talk more about.
We brainstormed about this 2 years ago at a developer conference, and the answer, which I didn't pursue, by the way, at that point in time, is the development industry does not have very strong lobbying. What you're talking about, a public-private partnership to basically modernize millions and millions of units in the US that should have another 50 or 100 years of life if we take care of them, I think is a very noble thing to do. It's more noble than what I'm doing, but nobody's actually doing it, right? I'm building more units, and so I'm adding to the supply of the US, so I'm proud of that. But I think maintaining the existing supply is something that should be done. And a lot of this really comes back to lobbying. People are getting money from Congress for all kinds of stupid things, building bridges to nowhere, trying to declare that natural gas is clean energy. I mean, all kinds of stupid stuff is being done. I think this is a very noble vision, but I think it all comes back to lobbying, because the government needs to play a key role in this for it to be worthwhile, for the profits to work. When I do it in Class A, that tenant can pay $500 a month more. So they're subsidizing all of this stuff for the future. But unfortunately, Class A construction, as I said, is a tiny fraction of the total volume of the US.
Yeah. Look, I'd love to talk to you for hours and hours and hours, but I do want to quickly pivot. You are a data scientist. I want to get your take on the multifamily space, where we are today. Where's the economy going? So let's just start with, what are your thoughts on, you mentioned earlier you thought the peak had hit in 2017 of valuations, or I think it was 2017, 2018. When we now came through another even resurgence, even more, just in the last sort of 24 months. Now we're dipping again because interest rates are tied to cap rates. What are you seeing in your crystal ball about where the value of existing multifamily is going, and then tying that back to where you think the economy and the global economy, we're both international. I do look at, I said to someone on the podcast before, show me in history when every single central bank has risen rates and has the same problem that every other single central bank has, which is inflation and global supply and COVID. I can't point to that. So it's a very new world we live in. But back to my original question, valuations of multifamily, how's that affecting, where we're going? Where's the economy? And what does that mean for global recession if we're heading into one?
Absolutely. So I think a recession in the US is inevitable at this point. The Fed has only once succeeded since 1961 in avoiding a recession when they're raising rates to kill inflation. So they've tried it 9 times. They won all 9 times. Just so you know, the Fed's very good at killing inflation. But of 8 of those 9 victories came with an artificial induced recession, right? 8 times. And the 9th time, the one time that they did succeed, they were raising rates at 1/3 of the speed that they're raising at right now. So the last 4 increases were 0.75. Collectively, that's a 3% increase in the Fed funds rate. That is the fastest single increase in history. I don't think that in any way combines with getting away without a recession. So you end up having a recession, but I think it'll come later than most people think. I hear people thinking we're in a recession or we're going to be in a recession in Q1. I find that our unemployment rate is ridiculously low. It still stayed at 3.7. The numbers came out yesterday for the last month. It didn't budge. And I don't think that it's possible to really go into a recession until you hit 4.5%. So I'm thinking the recession is the second half of next year. And the Fed will need to continue raising until the third half and then start to basically say, hey, we're done, and then start to maybe do some small cuts to start moving things forward. So firstly, I think this is longer than most people make it out to be. That's what data science shows. I have a very detailed model. I'm going to send it to you just for your comments and critique. I love getting critique from industry professionals like you. But I think what happens is we see values of multifamily continuing to drop until the end of next year. So I think that there's great buying opportunities here. This is a great time to be buying, especially starting next year. So once, I still think that prices are dropping for multifamily. I think that they will continue to drop. In my mind, I've seen 10 to 12% drops in markets, as many as 12% in terms of price drops from, let's say, the peak, whatever the peak was. Some people think it was Q4 of last year. Some people think it was Q1 of last year. Whatever that peak was, I think we've dropped about 10, 12%. Now, we may not have dropped in dollar value. And I'll tell you why. That's because net operating incomes have been going up. But if you adjust for the fact that we had significant rent increases this year, values have fallen. So an adjusted value per door is down 8 to 12%. And I think it goes down another 5, 6, 7%. I don't know when it goes down. My current model has a specific month where I think we hit the lowest price per door, the adjusted price per door. Remember, NOI continues to increase, so we may not be seeing a dollar decrease. So I think that happens in Q4 next year. But I'm very, 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 very bullish with multifamily in 2025 and 2026 because of that, because I have proof that supply holes are being created already across the US. The biggest benefit that multifamily is accelerated household formation, but because the 6 months or 12 months before a recession, during the recession, and the 12 months after recession, we don't build enough single family in this country, and we build very little multifamily. So we've already seen a small drop in multifamily and a large drop in single family construction in the country. Phoenix, for example, in November saw a 70% cancellation rate for new construction single family. 70% of the people that had put down deposits for homes to be built for them walked away. Why? Because they saw what was happening to rates and they knew they wouldn't qualify. So we're creating this big hole on the single family side. We're not yet creating a multifamily home. I haven't really seen a huge drop there, but I think it's coming in the next 6 or 7 months because financing is so difficult and so tight and so expensive. So I do think that we'll create a hole there. Now, will we benefit from this hole next year? Absolutely not. That's not what my data shows. My data shows during a recession, even though we don't have a shortage during the recession because household formation in the US becomes negative 6 months before a recession and tends to stay negative 3 months after the recession ends. So we basically have a shrinkage. People go live with mom in their basement, in their cars. They double up. They do whatever is necessary to get through that recession. So we don't get the rent benefit during that time, even though supply is dropping. But the moment the recession ends, 3 months later, household formation starts to become positive. And then 6 months later, it's quite positive. Then 9 months later, we're developing a shortage. And then 12 months later, rent tends to explode. And I think that explosion happens at the end of 2024. And we have an incredible 2025 in terms of rents.
So what you're saying is if you bought in the last 12 months, hold on.
Hold on for dear life. I know it's hard. I know you've got challenges. Hold on. Because if you're penciling a second half 2024, first half 2025 exit, if you can make it there, you're going to do good. You're going to be fine. Yeah. And all of this inflation is going to help you. I mean, inflation not going away. It's going to moderate to the point where it's not crazy and it's not destroying our financial system. But if it moderates, I think it moderates to 3%. Well, look at the last 30 years of rent. If inflation is 3%, rents are 4. If inflation is 4%, rents are 5. Show me a time in the last 30 years, except for 2009, when rents were lower than inflation. It doesn't happen.
Interesting. No, look, man, as I said, I could talk to you for hours on end because there's so many questions I have out of that around the different buying opportunities and how, things you mentioned earlier on in the piece about buying housing at 40% of what it costs to build. Well, I know stuff in Phoenix and Austin and Dallas are now existing stuff's trading at or above replacement costs, but then you look at the replacement costs and the difficult to get it in the ground. It's nearly like, well, I'm going to just go buy this existing deal because it's already there. I don't have to.
In most cases, I think it makes sense to buy those deals. Obviously, financing being an issue today, because I can tell you this, Texas is an area that I'm an expert in because I've built, all around Texas. And I can tell you this, Texas is now running out of cheap land with zoning, with permitting, and with utilities. Cities like Taylor's. Taylor's is famous city because Samsung's putting a $17 billion plant there, right? Guess what Taylor did? They called all the developers today and together and said, we lied to you when we said we had enough sewage. We gave all of our waters to Samsung because chip companies need trillions of gallons of water. We gave it all. So sorry, you can't build anything here because if you build it, you have to dig your own wells. This is happening across the board in the United States. It's happening so much in Texas, especially because of the growth. It's happening in Georgia. It's happening in Florida, where cities basically built sewage infrastructures 20, 30, and 40 years ago. And they're now at the point where they don't have the money to expand them or build new infrastructures. And so the U.S. is running out of land again, cheap land, right? We have the most empty land of any country in the world, but it's not of any use to anybody because it doesn't have roads, it doesn't have infrastructure, it doesn't have sewage, so it's practically worthless for housing.
Right. As I said, could talk about that issue because I actually built a lot of stuff here in Long Beach in California, and if you know anything about development, there's development fees to the city and infrastructure upgrades, particularly around water and gas. And it's not on the city to upgrade the lines. It's on the developer who's trying to tap into that. Yeah. More toilets, more gas stoves, more HVAC equipment. All of that comes with a fee. And you have to do an upgrade, right, of either the connection or whatever that might be in order to get...
Or build new connections if they're not there already.
Right, build new connections or tapping into an existing infrastructure that can't support you. Well, guess what? You then put your money into some pool that's apparently supposed to miraculously make the existing system better, but if you
over the next 2 years, so you have to wait for a while for that to happen, right? It slows everything down. Projects where my infrastructure was supposed to take 5 months are taking 12.
Oh yeah,
right. Now in the time, because of rent increases, that's fine. My budget still works. But the slowness is happening across the board in growing states. I'm not seeing it as much in the Midwest or in the Northeast, but in the Smile states, the Southwest states, everyone's running out of infrastructure, and this is not being talked about enough. We're hitting this crazy big 1,000-foot high infrastructure wall.
Yep. No, and there's a demand of keep moving and wanting to move around the country and all that sort of stuff. So, as I said, Neal, I could talk to you for hours, but at the end of every show, we like to dive into the top 5 investing tips. Ready to get into it?
Yeah, absolutely.
Mate, question number 1 is, what is the daily habit you practice to keep on track towards your goals?
It's called Miracle Morning. I wake up in the morning. I've read this book. It's absolutely amazing, by the way. and it gives me an hour to really organize myself. And I think I'm 50% more efficient.
Love it. I completely agree with miracle mornings and or any sort of meditation, sitting down, writing. No screens. It's got to be
no screens.
No
Absolutely
screens.
No screens. Yeah,
and no outside distractions. Even no like listening to. Got to get on the screen to get the audio. Nothing. So
nothing like that.
I absolutely love it. Question number 2 is: who's been the most influential person in your career to date?
Elon Musk. I think today he is Musk is a pariah, but I think. And people hate me for saying this. I think Musk is trying to heal the world, try to improve the world. If you look at his track record, that's what he's trying to do. He's bumbling. He makes mistakes. He says stupid stuff, especially on Twitter. But having said all of that, this person has a drive and a desire to change the world and make it better. And I admire that.
Interesting. No, I like that take on that. Question number 3. In your business, what is the most influential tool? And then when I say tool, it could be a physical tool like a phone or a journal, or it could be a piece of software you just can't run the business without. What is it?
My army in the Philippines. From the very beginning, I said, for every person I hire in the US, I will hire 3 in the Philippines. They'll be full times. They will work 8 to 5 Pacific, and I won't call them virtual HR organization in the Philippines to support them, to make them better. I'll pay them bonuses. I'll pay them profit share. I built that team, and it makes me, godlike in my abilities of what I can do.
Love it. Question number 4 is: in one sentence, what's been the biggest failure in your career? What did you learn from that failure?
Ego. I think that at some point, I started drinking my own Kool-Aid. I started believing that things that I said were true because I said them, because there were thousands of raving fans cheering me on. And I think that you make mistakes. Like in my case, in one of my the people that I look up to, Elon, has just made a very big mistake with Twitter. I think that he should have never bought Twitter. And I think that that's what happens. It's a process where you have so many victories that you start to believe that victories happen because of you. The truth is, you happened because of the victories. Some of them had nothing to do with you. Right. They built you up. You didn't build them. No,
checking you got the door is such an important thing, particularly as you're a leader of a company, of an industry, trying to be a thought leader. Yeah, having your 2 feet on the ground is, and not getting swept off with the head in the clouds, as they say. Last question, mate, is where can people reach you to continue the conversation? That will be in your sphere. Where do they go?
Multifamily University is the best. We publish a very large amount of research every year. We are geeks and dorks and nerds, and we love to publish information about everything that we're doing. And the best place is Multifamily University. Just type that in. I also am lucky enough to be the only Neal Bawa on the World Wide Web. So simply type in my name, Neal Bawa, and you'll see lots of interesting information. So you can add things to that. You can say Neal Bawa Data Science, Neal Bawa Best Cities, or Neal Bawa Virtual Assistants. And those will give you a bunch of webinars and podcasts about that subject matter. You can also do Neal Bawa Built to Rent or Neal Bawa Wellness Living.
I love it, mate. Well, look, thank you so much for jumping on today's show. I just want to reflect some of the things that I took away from today's show. I think, the wellness real estate industry is such an interesting niche, and I've built a lot of stuff well over a decade, coming as a structural engineer across many different countries. I love it in that it's pushing it forward in a way that we want to live cleaner and live better in terms of where we live within our boxes. The question that I have, and it's still unanswered, is how do we do it for everyone? Existing buildings, revitalizing existing buildings, all that good sort of stuff, and making it profitable, right? We won't be doing it otherwise; it's not profitable. But there is a need there, and it's government partnership, government-private partnership, which I agree with what you're saying. Really, really love that. Also love what your thoughts on the economy and how infrastructure is not many people are talking about it. And I can completely see that from my background and being in development. As you grow, that Taylor, where Samsung's being built, you can't just have a little town, have a massive mega factory come in and then not think the infrastructure is going to break, right? And thinking more of future-proofing certain cities to allow growth. But no one wants to invest in that. No politician wants to invest in that because it takes too long, right?
Yeah.
And so that in itself is going to be a massive problem coming into 2023 and beyond. And then your thoughts around where we're thinking interest rates are going to go and the price of housing. I like what you said about where do you think rents are, talking about the compression of housing, household formations versus coming into a recession, going after a recession, and then the growth of rents thereafter. So if you can hold on and you bought something and you're white knuckling it right now, keep white knuckling it until you can't, because Neal said it here, 2025. We're going to hold it to it, mate. We'll listen back, and hopefully in 2025 rents are going through the roof. But did I leave anything out, my friend?
No, that was very comprehensive, Reed. It's been an absolute pleasure doing this. Let's do it again.
Awesome, my friend. Well, look, thank you again for jumping on the show. Enjoy the rest of your week. Enjoy your time in Asia, because I know you're going there, and we'll catch up very, very soon.
Awesome. Thank you.